But now we're getting an instance where the DFL is also selling off, and that's further supporting the margin. So for me, as we go into higher run rates, I expect this relationship to flip. Hi, welcome back to another episode of Trading Corner. Slightly less eventful the last week or so.
Not on gasoline.
Not on gasoline. Okay, well, geopolitically, perhaps slightly less eventful, kind of more smooth on the flat price, I would say, as we still are kind of in this interim of whether Russia-Ukraine is going to relax a little bit. But yeah, maybe gasoline's a great place to start with. It definitely hasn't been calm, has it?
No, I mean, yes, we had pretty major liquidation. I think it's with hindsight, but especially at the front, it seemed like a lot of people were long, and I think stats in the US are probably disappointing a bit.
Yeah.
And we had a very aggressive kind of de-risking and a lot of stop outs.
So why do you think it came last week? Like, what was it specifically about last week that really forced the market to be like, okay, this is enough?
I don't actually think there was anything specific that looked that bad. I think stats the prior week had come in, they didn't look great, and stocks divided by demand, so like days of cover, looked pretty bad. But it wasn't kind of completely out of the range it had been in. So I personally was very surprised by the level of the kind of liquidation, and quite how much volume there was to liquidate.
Do you think it's kind of like spilled over from all this, Trump tariff stuff, like people getting a bit worried about whether they can actually book EBOB into New York Harbor, or is it just, an over-positioning that's happened here?
It could have been. I mean, we did hear that, and I mean, and maybe it did have a factor. Like people, we did hear of some people thinking that product was getting backed up in Europe because they were worried about shipping it and then being exposed to the. Sure.
And at that point, was the curve in contango in the front, or did this move force it into?
I think it already, because we're moving from winter to summer. We already had contango.
Okay, so a few different dynamics at play, I guess.
Yeah, but I mean, the front it came off a lot.
Yeah.
Well, what was interesting that the back end didn't move a huge amount, if much at all, and actually kind of gasoline to diesel further back in the summer kind of performed all right.
Okay.
Which is amazing. So it was just basically just a kind of a wipeout on the front few spreads.
Right. Do you think just off the correction down and the contango that people were being forced to put into storage, or they just weren't even using the curve to kind of move physical? It was just let's stop out on the paper and reset.
I think the market was paying people to store product, a bit longer than they might otherwise have done. And we saw that with the kind of the Belmont spread coming off, and maybe that reflected people worried about kind of moving product out of region towards the US. And
so what happened to the ARBs? Did they?
The ARBs have kind of been doing their own thing, but initially the ARBs like ripped. I mean, I think we also had a load of stopping out on the ARBs. So like again, due to the potential risk of tariffs on like Canadian and Mexican volumes, like particularly on Canadian crude, it's particularly quite disruptive to US crude runs and potentially extremely bullish the ARB.
Yeah.
And I think it's quite a popular trade on gasoline to be short the ARB.
Short the
prompt ARB, because they tend to roar off. So I suspect, again, and I think what was kind of confirmed by the pricing movement, that a lot of the market was short ARBs. You got a lot of people kind of got spooked by the potential for runs disruption in the US, and so ARBs initially ripped, which again kind of put pressure on Europe. But that's since calmed down a bit, and Europe's recovered. So it was
And is RBOB has that flatlined, or is that starting to soften relative?
No, I mean RBOB's actually kind of it's all kind of ticking up. I think gasoline's been ticking back up, but since the ARB kind of spike, it's come off a bit. So.
Okay, and I guess coming now into driving season, we're looking a month, 2 months forward. It's going to be hard to really put that much pressure on RBOB especially, but globally, EBOB should be picked up as well.
Yeah, typically now is kind of where you'd want to be getting longer kind of gasoline. And I mean, based on my numbers, I think FCC margins went negative first in the US, like in New York Harbor, they look negative. Oh, I mentioned it in previous weeks. So.
And FCC are like very much determined by where gasoline cracks are, right?
Yes,
a lot of gasoline.
It's predominantly a function of VGO, which is vacuum gas oil.
Yeah.
And where the gasoline price is. They're the main. So you feed VGO, and say like 60% of your yield is gasoline.
Yeah.
You make a bit of diesel and a bit of lights as well, but effectively, I think of the FCC as a gasoline making unit, and those margins don't look great. So if you're a refinery, you're probably max running your CDU, and then you're probably not max running your FCC at the moment in Europe or the US, in my view. Okay,
and I guess that gasoline stop out really didn't help those margins, did they?
I already thought the FCC margins were negative before the big stop outs happened.
Yeah.
But that pushed it even further into kind of negative area for FCCs, which is also interesting on the fuel oil side. So based on where FCC margins are now, potentially as a refinery, you might choose to make 0.5 fuel oils rather than run your FCC.
Right.
So we may find that this kind of blip in gasoline might feed through into some weakness in 0.5.
Yeah.
0.5 fuel oil. So that's going to be kind of an interesting one to watch as well.
Sure, that makes sense. So potentially we get a rebalancing of the products that are being produced, right? So
possibly. I suspect the 0.5 market won't be able to absorb it. So maybe we get some FCC run cuts. We get more 0.5 fuel oil production, and then potentially then 0.5 comes off, and it kind of rebalances that way, and then brings back the FCC margin.
Okay, interesting.
Or gasoline goes up. I mean, personally, I think we'll probably get a combination of all of that, and I'm probably more bullish gasoline than bearish 0.5.
Okay, and then typically gasoline trades quite actively with naphtha with propane, so the whole lights complex. Do we get those knock-on effects of that stop out on the other two products, or not so much?
Not so much. I didn't notice any big moves on those. I think naphtha and kind of lights kind of did their own thing.
Sure, so very much isolated, I guess, to gasoline. So it's quite interesting. We were talking about the margins last time, and we kind of had this bearish bias on them as we come into the end of maintenance, and we're expecting higher run rates. But the dynamics within the refineries are really quite interesting. Like, as you said, yes, one unit can have great margins, which is what we're seeing in very simple refineries. But then you move to kind of SCCs, and it's so intricately about a particular product. So despite gasoline getting really well offered in the front, actually the simple margin didn't really move that much, right? It's still at very healthy levels. So yeah, it's quite dynamic, I guess. So it'll be interesting to see where we move. But yeah, I do agree with you. As we come into driving season in the summer, we do expect gasoline seasonally to perform. Whether the short selling that we saw in the last couple of weeks is an indication of really, really bad demand, just for products generally, or it's just a liquidation event, I guess.
I think that's probably played into, so demand is probably not being great.
Yeah.
But I mean, you do tend to expect kind of weakness in gasoline around now anyway, because we're kind
of on the tail end of winter.
We're just about to get into driving season, and now's typically where you would be building and storing stock. So you need to pay to those econs to store it, and maybe those econs weren't I mean, this is with a massive bit of hindsight, but maybe those econs weren't quite enough because the market had got itself very long already.
Yeah.
Like, I think people love being long gasoline because it can rip, particularly in the summer. And I think we just saw an unwind. But interestingly, like, we've now had this washout pre-summer, so quite a lot of those deferred spreads are now potentially quite interesting. And we've had the washout. Okay, so it could be a super attractive time to kind of get back into these cracks. I think the super attractive time was probably like last Friday, because it's rebounded quite a bit since then. But so I wouldn't. I'm actually taking profit a bit on the. So I've liked kind of long gasoline versus diesel, and it's had even with this washout, it's actually had a decent move up. So I'm kind of chipping out of bits of that. But yeah, if it dips back again, I'll buy back.
Okay, interesting. And the distillate space, that's kind of, I mean, over the weekend we kind of had, again, this disruption between Hamas. And they called for a ceasefire. It's kind of been, they've pulled back on it again. There's still some disruption there. So that's impacted the East-West hemisphere. I think we did have a decent run-up on gas oil East-West, and that's kind of retraced since that fight, that war zone's kind of become a bit more active again.
That might be via the Red Sea, possibly.
Exactly.
Yeah.
So you have to add that shipping premium in somewhere, and it usually gets absorbed by the East-West. But gas oil locally, so Europe, what are you seeing there? Is that flatlined or?
It's been coming off at the front a bit.
Okay.
So like the front flies have come off. So I think the market was pricing, as we're kind of getting towards the end of winter and stocks in the US are quite low. I think the market was pricing a bit of nervousness kind of around on the front few spreads, but it's increasingly looking like the market's not worried about diesel supply or hitting tank bottoms. Mm-hmm. So it's been coming off at the front.
Okay, and we expect that to hold, I guess, into...
Probably. I mean, today it's moved off a bit. Just I think APIs last night, I think looked a bit more constructive than people were expecting. So the front crack boxes, like the June decks, have moved up a bit. But in general, I think the market's kind of comfortable. It looks like the market's comfortable. There's going to be enough product. So I wouldn't necessarily. I mean, I'm actually long. There's a slightly contrarian trade, a few crack boxes kind of at the front, and also to protect my kind of deferred short gas oil cracks via long gas to heat. But I've kind of got it as protection and not expecting to make much cash, if any, on it. But if gas oil does pop at the front, then I'd sell that out. But I'm not really expecting much.
Okay. So then just moving on to crude quickly, Europe, we kind of had a bit more buying appetite come in last week. I think the problem we're getting at the minute is we're getting pockets of demand in the physical crude because of the margins. They're doing super well. But the problem is with the forward paper contracts, with Asia in maintenance, the US in maintenance, the market is so obviously worried that there's going to be a whole load of TI Midland that's going to hit Europe and no one's going to be able to take it. So, and this is despite having strong margins. And the problem there is because if we're seeing reduced run rates in the Gulf Coast and then also in the East, that flow has to divert into Europe. And then you've also got local barrels there as well. So I think a couple of days ago I was reading that, still for West African oil, their March cycle hasn't totally cleared yet. There are rumours that we're going to hear of a force majeure on some of the Bonnie Light stuff, but it doesn't look like that's going to happen. So actually we've still got some overhang of WAF, which is never a great sign, to be honest. That's one of the specs that kind of gets arbed over to the east. And despite a low data to buy at the minute, it's just not workable because they're in maintenance. So they're not taking it. It also competes quite heavily with TI Midland, so they're generally quite light, sweet specs. But then Midland is trading quite cheap into Europe, so it's not clearing on that perspective. So it might be that we're going to have a couple of marginal barrels that aren't going to clear, and that's really going to knock data back down to where we were about 2 weeks ago. And this is, as I said, despite having very good refinery margins. So
But I mean, we debated it last week, and we've kind of gone in circles. But we are still right in the middle of. Well, we're coming out of turnaround, so it's natural that we'd have a crude glut potentially at the moment.
Well, the thing is, I totally agree. But what we're having is right now the prompt diffs around 80 cents. 3 weeks forward, those diffs are 15, 20 cents, and no one wants to buy them. So it's the kind of the reverse, right?
Okay.
You would expect the diffs now to be 15 cents and the forward curve to be 50, 60, 70, 80 cents. But the problem is, for April loading, mid to back end April loading, no one wants to touch the paper, which is really strange, I think. But then saying that, it takes one or two people to say, okay, I'm going to take five TI Midland cargoes, and then you're kind of cleared. It's just, does anyone in the market have the appetite to do that, or are they just going to be buying, kind of drip buying their cargoes? You know, they get a decent level here and there, and then they're happy with it. But as it currently stands, given where the margins are, I mean, let's see what happens with TI. Like, again, APIs, our market should be sensitive to APIs. If we started withdrawing in Cushing and Gulf Coast, it's going to have knock-on effects into dated. But, you know, so if those start drawing and with the margins where they are, I just think, I don't see why you wouldn't buy April, May dated, to be honest.
I mean, given the roll up as well to
exactly. It just feels very oversold at the minute. So perhaps it's a bit of a curve thing, but everyone's kind of buying May barrels on the paper, which is really implying those front rolls down for kind of front April, mid-April cargoes. But to me, it just looks oversold, to be honest. But
maybe that's
something
our trade idea for this week.
Yeah, I mean, we'll have a look at it in a sec, because I think it's really interesting, the relationship between margins and DFLs anyway. But if we're bullish gasoline, and we're, you know, going to the summer, you know, products, you kind of always find this, as you said, you find this marginal demand from somewhere. The risk reward is actually to be kind of long these products into the summertime. So if those products are going to hold, then crude has to kind of get a leg up as well. But yeah, we'll see. The only caveat is the TI spreads aren't doing particularly well. So we've had, you know, a fairly decent sell-off in the Brent futures the last 5 trading days, I would say. The front spread, you know, we're kind of in the season of rolling. So funds are selling the front spread to roll it down for next month. Which I expect will probably calm down in the next few days. But even still, they're not performing particularly well, right? And for me, it feels like it's a knock-on from TI. So I think TI, the front spread was down to around 15 cents yesterday, which implied the front box minus 15, minus 20 cents, which is typically pretty low.
Yeah.
As in,
you buy the box.
Yeah. The box typically trades around -5 to flat.
Yeah.
So it is, you know, the market's trying to tell you that there is probably going to be some TI that's going to come out for April. So yeah, it's a bit of an interesting time. I think the flows on the curve are kind of pushing the front down a bit too much. So let's see with expiry. We have expiry next week. If someone comes out, you know, taking that front spread, it could help overall the dated market. But yeah, it just looks oversold to me. So let's see. But yeah, on that point, let's have a quick look. So we have here on flux. So we, you know, I've spoken about this graph quite a lot. As a crude trader, I quite like looking at it. Not only does it keep me in touch with what's happening in the product markets, but also the relationship between a refinery margin, so that is the orange line, and the DFL can be quite interesting, especially when we're getting to kind of a pivotal point in the year where we're coming out of maintenance and typically into a season where you should get decent product demand. So you can see here, like, this recovery in margins, it makes sense when we're in maintenance. So, you know, you're just getting less product out, whatever. Like, the cracks are supporting this margin. But now we're getting an instance where the DFL is also selling off, and that's further supporting the margin. So for me, as we go into higher run rates, I expect this relationship to flip.
So yeah, I think that makes sense, and I mean, particularly as we mentioned, like in the last, like a couple of weeks ago in the last call, like probably like a simple summer margin. So yeah, as we like gasoline, effectively selling the straight run products, for which the CDE margin is super high. So I think that makes sense. Like crude demand picks up, so the DFLs perform,
Yeah.
and the simple margins come off
Yeah,
into summer.
exactly. So I think we can also have an instance where the crack holds and the GFL rallies. So the margin probably won't move, but the GFL will move, if that makes sense.
Yeah, I think there's scope for the simple products to come off as well. I think particularly when you look at those charts as well, we're coming out of a period, or potentially coming out of a period where we've had exceptionally high refinery margins due to war disruptions, with Russia. So if we're heading into a more normal kind of period for refinery margins, then actually the last few years maybe aren't that reflective of where they could go.
Yeah, definitely. We have there's a seasonal chart down here, and you can see even though we are in a very good simple margin environment, compared to last year,
Last year's they've been higher.
it looks relatively low, but it's still at pretty good levels, right?
It's still at decent levels, yeah.
So no, it'll be interesting. I do think, to be honest, the main mover should be in crude. I totally agree. The only caveat is if this Russia-Ukraine situation gets resolved and there's all of a sudden a huge influx of crude,
but then
is there enough space for that in the market?
But then in that scenario as well, then you'd potentially also have like a normalization. I mean, there's different scenarios and how things get resolved, and does Europe keep sanctions on or not? But potentially you'll have also, in that scenario, you also maybe have an influx of Russian products as well back onto the market. So
That's true.
that may pressure the margin from the product side.
That is true. So I don't think anything is going to be resolved, to be honest, in the next 2 weeks. So I think for now, I'd feel fairly comfortable that, the trade for us is short the margin and long the GFL. It's supported seasonally. It's supported, the GFL is probably, we'll have to look at the stats in the open interest, but it does look like it's getting to a point of oversold, especially on the rolls. So I think it's probably a great opportunity to start to enter into a position like a long GFL. But yeah, obviously there are a lot of things at play, especially macroeconomically. So, let's see. But from a physical perspective and seasonal perspective, I think it makes most sense.
Yeah, I agree.
Okay, well, let's see. We'll have, by the time we meet next time, it will be expiry. So, it'll be very clear which direction the market's going to go by then. Thanks.